Today is September 2nd, Wednesday of 2020. We have Dow futures up almost 0.5%. In futures, we have S&P futures up over 0.5%. And of course, we have NASDAQ futures up just under 1%. So yet again, we're at another day of reckoning bulls, aka the Fed, coming in and buying corporate bond ETFs and other corporate bond and debt. And they are seemingly succeeding in luring retail investors and institutions and more than likely commercial banks, right? Because that extends lending growth. So with that luring going on by the Fed, they're able to attract these people, the rest of the world practically, to buying FANG stocks, right? That's why they've become the most weighted stocks in the major indexes because of their increased market capitalizations, right? Tesla's worth, Apple's worth $2 trillion. Jeff Bezos is worth $200 billion. So the list goes on, and the wealthy are getting much, much wealthier. The super rich are getting ultra super rich, and the poor keep getting poorer, aka homeless. So the wealth gap is bigger than it's ever been, ever before. By the way, today in 1666, the Great Fire of London actually, it literally burnt the entirety of London, which was home to about 350,000 people prior to the actual Great Fire, which literally made London the largest city in Europe, one of the largest cities in Europe. And basically the reason being is because, they weren't prepared. In the 1600s, they didn't know anything about, they weren't nearly as aware of fires and, the dangers of fires and the ignitions of them at all relative to how we know them now. So they were not prepared. They're, for example, their roofs were called, I believe, pitch is the term, Pitch, which is a very flammable kind of product that they used for roofing, among other things as well. So they had a very droughted, dry summer, and it was just a recipe for disaster. So that's what happened, literally 400 years ago today. I believe it was a Thursday when it happened in 1666. But the chaos lasted for 3 days. So, all of these bad things in history have been happening on days where, in today's reality, things look as though they're amazing and spectacular, right? Everybody's 401ks are through the roof. Anybody that's indexing per se. But, in reality, our economic environment is nothing more than Zimbabwe's or Argentina's. Speaking of Australia, they actually hit their first recession in literally 30 years, in 3 decades. So that's definitely something. Even emerging market credit yields just dipped to its 2013 low at roughly 4%, but it was almost 8%, at its peak during this pandemic. And in Brazil, right? In Brazil, 30% of the population gets 100 or something dollars a month, and that is considered the most ambitious social program. The UBI program in the US was 600 a week. Well, 600 a week. Now it's 300. And, it's not deflationary. Okay. 10-year yields, obviously, at around 65 basis points. It's been the most volatile move on the dollar there's been. And usually the 30-year is the most volatile treasury on the curve. And U.S. treasuries actually tend to correlate strongly with US ISM manufacturing PMI data, which is almost 3% right now. Right, manufacturing data has been fairly rebounding, obviously, as things reopen, and but it's still relatively low. But there's a strong divergence now, between U.S. Treasuries and manufacturing PMI, and there really shouldn't be. So that's another reason to be skeptical of our current situation. Right, our 2 year is at around 13, 14 basis points. I think the 10-year now is at around 68, maybe 69 basis points. And our 30 years been it's been at 1.45, 1.4 for the past, it's pretty interesting. So it's kind of transverse, the way our yield curve is literally, reacting in the most opposite way it would be now. Because the Fed is literally taking these treasury auctions to the next level. Billions and billions of dollars are being committed and accepted by primary dealers primarily. Indirect and direct dealers, yeah, indirect dealers, right, the foreigners, they've been buying a whole lot of treasuries lately throughout this pandemic, and not just throughout the pandemic, but before so. And that's why, they're holding these dollars that are extremely levered. They're probably worth around 50, 60 cents on the dollar, 40 cents on the dollar, because the Fed spends the other 60% of the dollar's quote unquote value. So, these post-Keynesians say that you need to spend money in order to make it value, to make the dollar valuable again. No, that's what loans are for. Loans are meant to spend. Loans are meant to be spent on, something that, as long as you can return the principal and whatever interest is filed. In this case, obviously, this creates a sudden emerging factor in refinancing mortgages at these extremely low rates. Like I said, the 30 years, if you were to get a 30-year mortgage at 2.5%, 2%, you're getting a bang for your buck, so why wouldn't you? But the problem is that people don't realize, just like in '08, is that interest rates are going to be forced to go higher. Obviously, the Fed, nobody can afford higher rates right now, because the only people that are buying these rates are the Fed practically, and commercial banks. So we need to watch out for this. We need to watch out for the trend of this. And, and just for the sake of, showing you some more data, I thought I would share my screen here. So let's share that screen. Should be able to see a chart of the monetary base going back all the way to 1960 till currently. So the past 80 years, we have literally seen an exponential increase in our where it really, frankly, started the spiking back in '08. This is the largest spike we've seen in the monetary base since 1960, back in '08, right? Because Obama and his predecessor, they were forced to stimulate the economy with fiscal and monetary policy, and that's where the ignition of that exacerbated till currently, right? We never really recovered from '01. We definitely did not recover from '08, and here we are today. So that, hence the monetary base, which is, it's at its all-time highs. Obviously, if we look at it on a little bit more of a micro sense, we see that, yeah, lately the monetary base has actually been decreasing, right? The Fed is trying its best to contract its balance sheet and splur inflation, right? Because we heard from Powell that we want average inflation to be as variable as it wants to be. There's no limit for inflation according to the Fed. So they will continue, contracting their balance sheet while buying out what the government has collateralized for the Fed, and they're just going to buy it all from the government. The government is the collateralized, they're the collateralized party for the Fed. The Fed doesn't initiate anything really. The FOMC, they perform market operations, for treasuries and mortgage-backed securities and whatnot. But those are securitized forms of what the government collateralizes. The government can collateralize anything because they could put a value on something like $1 and manipulate it by devaluing its world reserve currency status. And eventually we're going to need it to be replaced by something that's real, by something that has use value like gold. So that is kind of all I wanted to share for today. Let me just, still getting used to this, this whole video taking, recording thing. But I hope that made more sense about where we are in the economy, because we're at a very bad place. And I don't think we've seen the worst of times just yet. You know, of course, we have things like social unrest, we have economic disaster, we have political nonsense and disgraceful political politics, and everything's disgraceful on what's happening recently. And something needs to be done, but nothing can be done because the Fed has used all of its ammunition it possibly can. The only thing left to do is to let the wound bleed out and let it heal and let time go by. That's the only thing that can be done, because, if we wanted to let our free market be our free market, we would have done that decades ago. Like I said, the process was only exacerbated in terms of debt monetization. That debt monetization is exponentially monetized, especially in the year of 2020. Right? We just added literally $5+7 trillion to our balance sheets, to our trade and budget deficits, to our overall national debt. We've added trillions and trillions of dollars, nothing like we've ever seen before. And yeah, we're trying to ease, we're trying to ease the economy by loosening rates, but with tightening financial conditions, how's that going to happen? So what we'll probably see is a more of a short-term reflationary environment alongside with a potentially hyperinflationary environment. That's what it can very well so escalate to if the US dollar falls, which it has been, the US dollar index. So although it's primarily made up of the euro, it's still indicative because the euro is trading at around 120, 119. 120 is a huge resistance for the euro against the dollar. So yeah, euros are more expensive than the dollar. The dollar is continuing to lose its value though, because the Fed and the federal government is devaluing its value. So I hope that helped everybody. You will hear from us again very soon. Please make sure to like this video. It helps us a whole lot, and to definitely subscribe, because this will be a periodic type of podcast series, and you'll be hearing from us much, much more. So thank you for your time.